A very good afternoon and welcome to HYCM's online trading workshop with myself, Giles Cochran, the Chief Currency Analyst here at HYCM. Hope everybody is doing well. Very nice to be here. Hello, Ashwin. Good to see you. Van, great to see you back. Vic, Warren, lovely. Lolu, that's super. Lovely to have you here on board. Just as other folks are coming in, I'll just go through the disclaimer, which I need to go through each week. And just to make it clear that as we're going through different trade entries, exits, different instruments, this is an invitation to trade. The whole idea of this webinar is that it is a trading educational service. So you can, as it were, look over my shoulder, see how I go about making my decisions, and you can learn from that, and hopefully that informs your trading. But the whole point of this is not a signal service, just in case some people can get confused. And obviously, because the market changes so quickly, what's sensible in 1 minute can quickly become not sensible the next. So just to make that clear, I think most folks are in now to the webinar. And the first thing we're going to do in this webinar is, of course, look at how to determine which currency pair to trade. Now, in trading, my philosophy is that you want to have a fundamental bias for your currency to trade before making those trading decisions. Essentially, a trading decision is best made when you combine fundamental knowledge and technical understanding to make that decision. So the key way that I like to think about it is, if you had to guess which of these two arms would win the arm wrestle, you'd say, well, I think the strong arm will win the arm wrestle. So this arm is, more than double the size of this arm. So you'd always expect the bigger arm to win the arm wrestling competition. You'd look to back the strong person against the weak. Now, in fact, exactly the same way, a key philosophy to grasp is, in trading, we want to back a strong currency against a weak currency. That way, we have most certainty about the probable direction of that currency pair. So that's the philosophy behind the trading decisions. Now, we're going to go over to the markets, and I'm just going to show you the dominant currency pair for today. Now, the dominant currency pair for today is the pound US dollar currency pair. Now, there's been more Brexit optimism today that the UK is expected to strike some kind of deal with the EU before year end. The market has a bias towards a deal taking place. This morning, there were some positive comments on the wires, and the positive comments said that Michel Barnier was optimistic that an agreement could be reached between the EU and the UK. That sent the pound ripping higher earlier in the session. Now, we're also seeing some extensive dollar weakness in the markets at the moment. Now, over a medium term, there is a bearish bias on the US dollar. With Joe Biden ahead in the polls, the expectations are that if Joe Biden becomes the new prime minister, the new president, rather, I should say, of the United States, then the US aggressive America first policy is going to be reversed. And Joe Biden will be much more sympathetic to world trade. And that will be, as a result, be good for the world, but it will be a dollar negative. So we're seeing the dollar being sold on our expectations of a Joe Biden victory. And you can see here, these are the latest polls. And in the latest polls, you can see that Joe Biden, in the Democrats' blue, is ahead of Republican red Donald Trump in the polls. So as long as Joe Biden has that lead, the markets are expecting a Democrat victory, and that Democrat victory is expected to weaken the dollar. it's positive for risk. That's why we see that the dollar at the moment making fresh lows, even as we speak, on anticipation of that Democrat win. Also, what's driving the dollar lower today is the expectations that a stimulus bill will be passed. Now, Nancy Pelosi had set a deadline of yesterday for a US fiscal stimulus bill to be passed. She's extended past that deadline in anticipation that some kind of deal, some kind of stimulus deal can be struck. Now, that stimulus deal is very positive for risk. And at the moment, as we've been seeing, when risk is positive, that weakens the US dollar. So expectations of a Biden win and expectations of the US stimulus bill is weakening the US dollar. That means there's a bias to buy the pound against the US dollar. And any retracements back to that level, that 1.300 level, can be considered suitable for going long. And for the more aggressive trader, you could consider going long from this higher support level, just coming in around that 130.60 level. That could be considered suitable for going long. So 130.60 and that 1.30 handle can both be considered suitable for longs. Now, with the dollar being so weak, that does also open up the opportunity for a gold long position as well. Now, we can see gold at the moment is trying to break out of this key descending trend line to the upside. A break and close above this on the daily chart is very bullish for gold. The dollar weakness is lifting gold at the moment. So if we just take that trend line off, and if we overlay the dollar index on the gold chart, you can see that when in the turquoise line, when the dollar index falls, gold rises. When you see the dollar index rising, you see gold falling. And when you see gold falling, you see the dollar rising. So at the moment, with the dollar in the turquoise falling, that's positive pressure to the upside for gold. A break and close above this level could be considered suitable for longs. So as long as the US stimulus package is expected, if we get a break and close above this level, we can anticipate higher prices. Now, the way to trade this, again, not trading advice, but if you become convinced that US stimulus bill is coming, then it's a simple matter of buying at market, stops running below that 1850 region, and then if price closes back underneath that trend line, the trade could be exited. So the way to trade this is as long as you're above this trend line, the bulls are in control. Below this trend line, the bears are back in control. Have an emergency stop just underneath that 1850 level. Now, the reason that we would be so, I personally am so happy to buy gold is that the medium-term perspective for gold is good. Low interest rates. Federal Reserve not expected to raise interest rates till 2023. We've got large movements of exchange-traded funds in gold. We have cash with negative interest rates in some countries and very low interest rates across the world. It means the incentive to stay on cash is less and less. All of this enhances gold's appeal. So there are bullish reasons for gold, and if the stimulus bill gets passed, then that's a good tailwind for gold, and expect gold to rip higher back towards that $2,000 level. Now, just taking a look at the intraday chart, this could be traded from an intraday perspective, and you can see that any retracement back down to that R1 level, anywhere between that R1 and 1910 level could be considered suitable for going long in, finding that support just there above the R1 level, trying to push higher. So the two kind of dominant sentiment pairs that we have, well, not pairs, the dominant currency sentiment pair we have is the pound US dollar to the upside and gold to the upside as well. And we can see that upside is in play on the commodity of gold. So it would be a very similar outlook for silver as well. So silver could also be considered suitable. And if we just take a look at the silver chart, you can see almost identical setup. And again, here, what you'd be looking at on silver would be some break. A break of that trend line would open up the door for higher silver prices as well. And on the intraday charts, you'd be looking, any retracement back down to that 24.90 level could be considered suitable for going long on. So that is something to be looking at. And I hope you can see that principle of pairing along. Now, what would negate the outlook? Now, what would negate the outlook is if the US stimulus bill doesn't get passed. If the US stimulus bill is cancelled or it's not going to happen before the US elections, we would expect sudden strength coming into that dollar. We'd expect that dollar to rip higher. And that dollar ripping higher would pull gold and silver down as well. So that's something very much to be aware of. And again, if we start seeing the polls narrowing, if we see Biden's lead narrowing and narrowing, that would be negative for risk as well, because there is concern over a contested US election result. And the closer that poll gets, the more likely a contested result will be. There's a phenomenon called the blue shift. I'm going to send you all an article I've written on this phenomena called the blue shift. Let me just, I'm just going to dig that article up and send it to you. Yes, here we go. So I'm just going to send that to you here. So in the question and answer panel, I'm going to send it to you in the chat box there. And that article explains the phenomena of the blue shift. And basically what it is that when polls and votes are counted, it tends to favor the Democrat parties. So in the historical elections since the year 2000, any postal votes tend to have a bias towards the blues, the blue shift, towards the Democrats. So that means if the election is contested, then there's a chance that it could be a Democrat advantage. So you could have a scenario where Trump appears to have won, but actually when the postal votes are considered, actually it's a Democrat victory. And we can all imagine the sort of chaos that would cause with President Trump. So no, they're the two things to look at. Obviously, with the pound, the concern over the pound, you've only got to get a negative Brexit headline, and then you see the pound sink. So risk is very much tilted towards the downside for the pound. This deal between the EU and the UK is pretty much priced in nearly. So I think if we do get a deal, we might see prices testing 1.3500 and then prices selling back down in the near term. So there are expectations that a deal will be done. So of course, if a deal is not done, and if a deal does fundamentally break down, we expect heavy selling in the pound, and I'd expect prices to make their way down to that 1.2200 region, and then ultimately down to that 1.200 handle. So that's something to be aware of in terms of trading the pound dollar. One of the other areas I'd like to share with you, one of the special areas to be looking at is the rise of the yuan in the FX space. Now, the yuan is becoming more and more popular, and in fact, the China's yuan could become the world's third largest reserve currency in the next 10 years, according to Morgan Stanley. And what they're predicting is that the yuan could go behind the US dollar and the euro as the next most widely traded currency. So we need to be aware going into the future. Let's just have a look here. We need to be aware going into the future here of the impact on the yuan. Now, take a quick look here at the US dollar versus the yuan pair. You can see here. Right, you can see how the yuan has been strengthening against the US dollar, and it's now it's 6.6, and all this dollar weakness and Chinese yuan strength. So you can see how the concern of the People's Bank of China recently, where they've tried to prevent some of that yuan strength coming in too fast, too quickly. But this relationship is expected to carry on because there's more increased foreign investments into the Chinese markets, and that's boosting the yuan as more and more inflows are coming into China in order to purchase different products from China. So, for example, if you want to buy, shares in the FTSE 100, you have to convert your money into pounds. If you want to buy shares in the S&P 500, you have to convert your pounds into dollars. So if you want to buy Chinese products on the Chinese indices, you need to convert your currency into the yuan, and that obviously causes it to increase in value. So this is something that FX traders need to be increasingly aware of over the coming months and years. The yuan is set to become increasingly strong. Now, the setting of the yuan at the moment is done internally by the People's Bank of China. So you have a domestic yuan and an external yuan, and the rate of the domestic yuan is set by the People's Bank of China. So the currency is not totally free-flowing in the way that, say, the pound or the euro or the US dollar is. But if that becomes more and more open, and as the yuan rises, we'd expect to see a more sort of libertarian view and a libertarian flow of the yuan. So just to be aware of that, we're expecting further yuan strength and further US dollar weakness, and particularly if we get a Biden victory, as long as Biden's expected to win, that's expected to be positive for China's yuan, obviously because Donald Trump would be out of the presidency, and Joe Biden is not expected to carry on with that antagonistic relationship between China and the US. So that's another key aspect to be aware of as the yuan becomes more and more important and expected to overtake the Japanese yen. Okay, so at the the yuan counts for about 2% of global foreign exchange reserves, but it could rise up to as high as 10% by 2030, which would take out the levels of the Japanese yen and the British pound. Okay, so just to be aware of that, we are seeing that rise of the yuan and the potential for that to overtake the yen and the British pound. It's just an expression really of the confidence and the growth of China's economy. It's the second largest economy in the world, and the rise of the yuan is just a natural extension of that. Now, I'm going to go over to questions. So if you've got some questions, please do ask them. Anything in the market you would like help with, anything you're struggling to understand, anything you would like to help me explain. I've gone through a couple of interesting setups for us, but these are the key aspects to be looking at. So I hope that those that's helpful for you. Yes, Warren, a great question. Does the People's Bank of China or Chinese government want a strong yuan? No, you're absolutely right. They became concerned about the rising strength of the yuan, and they tried to intervene recently by impacting reserve levels to try to stop the rise of the yuan. They tried to do it, I think, about a week ago, and you can see pretty much unsuccessfully. But what they wanted let the world know, Warren, is that they're not just going to sit by and let the yuan get stronger and stronger. You're absolutely right. Because of the strong export nature of China, a very strong yuan will impact the export economy. So they don't want, and what they don't want to see is this. They don't want to see the yuan just getting stronger and stronger. You know, a little bit of movement, pullbacks, that's okay. But when they're just seeing this unfettered strength, and what they became particularly worried of was seeing Biden ahead in the polls. They were just becoming a bit worried that they're going to see a one-way trade of a very weak dollar and strong yuan. Yeah, can we go through Australian dollar, Canadian dollar? Absolutely. Okay, so the first thing with the Australian dollar, we're at an interesting point, Titus. The interesting point is this. The Aussie dollar has been selling off from last week on expectations that the RBA are going to cut interest rates at their next rate meeting, which is November the 3rd. So Governor Lowe has essentially said, and the RBA minutes confirm, that the RBA is open to a rate cut and they're open to buy bonds further down the curve, and they want to help support the Australia's economy by cutting interest rates further. That's negative for Australian dollar. So why, you say, Titus, are we seeing Australian dollar strength at the moment? Well, the strength is when we're seeing the dollar weakness and the general risk on tones. So we're seeing gentle support at the moment in the US future markets, but the interesting markets are the bond yields. We're seeing bond yields pushing higher, indicating the market's open to risk. Gold's pushing higher, even further now, going over that 1924 mark, heading to that 1925 barrier. We've got copper pushing higher. So although the yields, bond markets, and the equity markets are diverging, the big picture is it's more positive for risk. So in that kind of environment, we expect the high beta currencies, the Aussie, the New Zealand dollar, and the CAD to benefit. And that's broadly what we're seeing. We take a look at the currencies as a whole. We see that the Australian dollar and New Zealand dollar are broadly moving higher. CAD, a bit of a mixed picture. We've got CPI data and retail sales data coming out as well for Canada today. Let me just have a look whether we've had that data out at the moment, whether it's still to come. And then we've got that. We've got that. Yeah, so we've had the CPI data out as expected, a little bit better on the year-on-year and a bit better on the new housing index, but that's pretty much as expected. Retail sales are just slightly below expectations, but within the minimum and maximum expectations. So nothing particularly driving Canada there from the inflation or the retail sales data. So we would expect broad commodity currency strength. We're certainly seeing that in the New Zealand, Australian dollar, less so in CAD. Oil does have its own drivers, so CAD could be pushed around by oil at the moment. Remember, we're also waiting for the API oil inventory data coming out, not the API, the EIA weekly crude stocks. We had the private data out yesterday, so we're looking at 3:30 to see that. But all of that is, this risk on sentiment is pushing the Australian dollar, New Zealand US dollar higher. And you see that dollar weakness, which is, you know, accelerating even now, is just pushing the pairs higher and higher. And this is all an expectation of the stimulus deal. So we've got reasons for Australian dollar strength. Now the CAD is driven by the risk sentiment and what's happening in oil markets. Now oil markets have been pretty flat. We had the JMMC meeting and the OPEC Plus meeting this week, and essentially they didn't make any changes at all, but what they have warned about is slowing demand into year end with rising COVID-19 cases. So that's why we've seen pretty flat oil markets. We saw a surprise build in inventories of the private data, and market is now expecting a draw in inventories. So you can see market expecting a draw in inventories of minus 1 million barrels draw expected, and if we got a build, that's going to be negative for oil. So oil sort of range bound at the moment. That's impacting the CAD. So we are seeing sort of a little bit of range bound flip-floppy action in the CAD. So in terms of the Aussie CAD pair, what do we actually have here? Well, we have upside because of the Australian dollar, but we got the oil inventory data coming out at 3:30, so that could change the outlook of the trade. Also, with the Australian dollar and the Canadian dollar both being commodity currencies, in a risk-on environment, they both gain, and in a risk-off environment, they both lose. Okay, so at the moment, I'd be neutral on the Aussie CAD currency pair. I'll just have a neutral bias on the pair. And obviously, with the RBA expected to cut rates in November the 3rd, spikes higher are likely to find sellers as well. So I would have a neutral bias on the Australian dollar, Canadian dollar currency pair today based on the fundamentals. Now, what would change it is if the inventory data came out and we got some bad news for oil. So say we got a build in inventory levels above 2 million. So if crude stocks have a build above 2 million, that'll be negative for oil and negative for CAD. And so you'd expect then to see more upside in the Australian dollar CAD. And you could look at potentially joining from a retracement to one of the pivot points. But as it is, I've been waiting now for that crude data coming out. But at the moment, there's reasons for both strength and weakness in both of them. Yeah, what do you think is our target profit to get out for a gold bullish move? Yeah, good question, Warren. It all depends on what your time frame is, Warren. So as long as that stimulus bill is still coming, then the risks that you've got then are the US stimulus package and then the US elections. So I see three risks for gold ahead, all dollar related. One is the coming US stimulus bill. If that keeps coming, there's more gold upside. Two, as long as Biden's ahead in the polls, I expect that to weaken the US dollar, more upside for gold. Three, Warren, it's the actual election results. Because in 2016, the expectations going into the election were reversed on the result of the election. So there was always a risk of a buy the rumor, sell the fact response on the actual election night. So in terms of a gold target, if you're intraday trading, a target is that 1930 level, that 1930 up at the recent highs. If you're trying to hold for a bit longer, then the first obvious target after 1930 will be up to that 1950 region, okay? And then from 1950, it will be up to 2000. So the three targets I see are 1930, 1950, and then 2000. You might want to bring it in. Yeah, 2000 is fair enough. Maybe a little bit lower, 1990 or something like that. So there will be the first targets that I'd see. Although, the outlook for gold is expected to be bullish longer term. So some people might be trying to hold it longer, maybe even looking to take out these highs. So it all depends on your time frame. But they're the three targets that I see ahead. Warren, Aussie CAD is like metal versus oil. Yeah, it's not a bad way. That's not a bad way of putting it, Warren. The only issue with CAD at the moment is some of its relationship with oil has broken down recently, which has been a bit frustrating. So just watch. I'm just a little bit cautious on CAD with that relationship with oil is not such a strong correlation. But rising copper prices, rising iron ore prices, all of that supports Australian dollar. So basically, anything kind of it's kind of a global growth stroke metal versus oil. So as long as the globe is growing, expansion is expected, that is upside in Australian dollar. And of course, if the world's growing, then you're expecting to see upside in oil and metals. So that's why the odd CAD is there's not many situations where you easily want to be trading in the Aussie CAD, except probably in a central bank divergence. Yeah, no, you're welcome, Warren. I think, you know, fundamentally that's right. Yeah, so interesting times, but you know, the thing that's happening at the moment is this is all, yeah, that's it. Good for risk on trade. The thing that's happening at the moment is the market is just laser focused on this US stimulus package. That is the absolute focus. So what is of interest of note here, you can see, look, normally when you get yields pushing higher, like you've been having here, US, Canadian, German yields, New Zealand yields, Japanese, UK yields, all yields are pushing higher. You typically see equities pushing higher, but you've seen the opposite. We've seen equities pushing lower. So the question is, which one's right? Is it the equity market or is it the bond market? Normally, the bond market is the market I go for because bond traders tend to have a longer term perspective, 6 months to a year, and they're slightly, they take a more longer view. And one of the interesting aspects at the start of this year was when there was a divergence between bond yields. This is happening again. I really want this to. Hang on, let me just bear with me. I just want to just try to. That's it. Got it right. So you can see here that of January this year, just go to January. There was this divergence that was setting up. I'll show on the daily chart. It's easier on the daily chart. Great. Here goes. Right. You can see normally the normal relationship is when bond yields rise, equities rise. Okay. When bond yields fall, equities fall. Okay. Rising equities, rising yields. Falling yields, falling equities. That we started to see a divergence at the start of the year in January. We started to see, look, yields were moving lower, but equities are moving higher. At the start of the year, many market participants were saying, well, which one's correct? Are equity markets correct and the yields will follow them higher? Or is it the bond traders who are correct and yields lower and equities are going to follow bond yields lower? Well, we can see, look, it was clearly the bond market. See, the bond market was dropping here and here, even as equity markets were rising. And this divergence formed. And canny traders would have recognized that. And I remember writing and putting up posts on this at the start of the year. And this is the 10-year yields against the S&P 500. So when you see this divergence between yields and bonds, pay attention. Now, in this case, it was the yields moving lower while the equities were moving higher. Well, at the moment, right now, we have the reverse situation. And we have a situation where equity markets are moving lower, but yet the bond yields are pushing higher. Now, one of these is going to be correct. Now, the reason this is happening is we know because there's a US stimulus bill that's being spoken about. And if this stimulus bill gets passed, then expect the equity markets to follow the bond markets in suit. But that's what's going on right now. So you can see volatility rising. Okay, now the volatility is rising because there's a lot of risk in the market, and you know that risk is being felt. But also, look, you see copper prices pushing higher as well, which is a good risk-on sentiment. So we are in a kind of funny market environment today. But as I said, pound US dollar longs, gold, silver longs from pullbacks do make sense. Titus says, is pound US dollar a better short than long at the moment? No, because we've got Michel Barnier, who, this is the thing, Titus, if you go through the reasons, look, we've got the US dollar weakening, Titus, okay? We've got the pound strengthening on positive Brexit comments. So you can see the pound has been just one or nearly one way, and that's for a reason. That's not, no reason. So intraday, our bias is to buy the pound from any pullbacks to that 1.300 level. Now, zooming out and from a wider term perspective, is the pound a better short than long? Well, you could argue that any retracement, any move back up to this level on a Brexit deal would potentially be a good short. The reasons are as follows. The UK still has a lot of difficulty. Rising job losses are expected. We have the central bank struggling to support the UK economy with chatter about negative interest rates. We also have the fact that the UK has rising COVID-19 cases and is more likely to go in stricter lockdowns. So medium term, if a deal does get struck, which is expected to be struck, then you'd expect some pound US dollar sellers potentially from this 1.3500 level. So on an intraday basis, it's a better long. From a medium term perspective, arguably it's a better short, but we'd want to see a deal first. Okay, so looking technically, you can see that that's retesting that key trend line on the weekly chart. Get above and prices can potentially move higher, stay below and prices are moving lower. What you want to do, you always want to get into the habit, Titus, of not just looking at the technicals, not just looking at where price is, but understand the fundamentals. Understanding what's fundamentally driving a currency or a commodity. It's a bit like with the gold chart. Like when we're looking at gold, we're not just looking at gold because it's broken through this trend line. That is not the driver for me and I'm looking at gold. I'm looking at gold because I have a fundamental bias to buy gold in current market conditions. And then I'm applying the technicals to find a way in. Okay, and I'm also using the technicals to find a way out. If I close back below this line here, then I'm questioning my longs. But always use the technicals second and the fundamentals first. When you start doing that, it works a lot better. You don't want to just look at a chart and go, oh, this is a key support level, this is a key moving average level. Use both, Titus. Use both technicals and fundamentals, and then you're more and more putting odds in your favor. I hope that helps. Okay, everyone. Thank you all very much for your time. The chart, to keep an eye on is this gold chart with the US stimulus package. That's the one to keep your eye on. If the stimulus package fails, then we'd expect gold to close back down underneath that trend line. As long as there's hopes of a US stimulus package, then you'd expect gold to be supported. I hope everybody, yeah, no worries, Titus. Everybody, take care, look after yourselves. Scheduled to be back again next week, of course, at the same time, same place. Look forward to, yeah, that's great, Warren. I'm glad that was helpful. Great to be here, and yeah, I'm glad that was good. Take care, everyone. Now, goodbye.